Good afternoon. This is Phil Love. It is March 28th, 2020. I am speaking to you today about the impact of the COVID-19 crisis that we have on our economy and our borrowers, and the impact we have in our credit administration and our institutions, and how we can move forward from this. I am president of Pactola. We are a credit union service organization. We work with commercial and agricultural lending in 4 ways. The first is we help underwrite, syndicate, and then service large loan participations on our platform. The second is we work with all kinds of back office credit admin support functions, whether it's underwriting, risk reviews, government guaranteed lending like SBA, FSA, rural development, writing policy, document prep, and whole plethora of stuff along that line. The third is lender education. We have about a dozen classes that we've written that are in-person classes, and we're working on some alternative delivery options for distance learning for some of your team. And the fourth is credit risk advisory services. We have a group of ex-banking examiners from the OCC and FDIC and NCUA that we work with, and they are able to provide third-party loan reviews, credit risk advisory services, problem loan workouts, a whole smattering of things like that. I wanted to start out today and talk about that the hour for a leader is when there is a crisis. When I think of a crisis and a leader during a crisis, one of the first persons I think about is Winston Churchill. My hometown of Fulton, Missouri is where Winston Churchill gave his famous Iron Curtain speech that was talking about the dangers of communism in Europe right after World War II. And there is a memorial to Churchill that's there. If you have never come and visited, it's a wonderful, wonderful place to go. And it was amazing the stuff that he did in terms of keeping the British morale high, keeping Britain safe, and also leading Britain to group up with the rest of the Allies and also defeat the Nazis. Our current COVID-19 virus is a unique crisis, and this is something many of us have never seen before. The economic impact from this crisis may be as bad, it may even be worse than the actual virus itself. And we know that the virus and the economy, that both health and the economy has a serious impact. And I think once this is completed, one thing that's going to change in our national mindset is the linkage between the health of your nation and also your economy. None of us has the answers that we need. And we need to be very flexible as more new information comes in, oftentimes hourly. And in many cases, you as a leader and as a lender may be the only defense that helps keep your business open, that helps keep your borrowers to preserve some of their equity and keeps them afloat. And now is also the time to make plans of what you're going to do in terms of moving through this. The world has changed. These 3 little pictures here show some of that. The one in the middle, I know where a guy's drawing, just looking at a map for some weekend travel ideas, and he has like a little architectural drawing of his house. That is a reality that many of you are facing, because many of you have gone from going into an office at your institution to going home and working from home. And on the end, with the issue without sports, self-quarantining may have some advantages where you can plug in and discover your wife or your spouse or your kids more. But we are in the time right now where there's no March Madness. Baseball. Thursday was supposed to be the start of the Major League Baseball season. And we have no sporting events that we have that are anytime on the horizon. It is definitely a different world. You wonder how ESPN is going to survive with a situation like this. We first wanted to start out where the economy is. This was from a uh, webinar from CB Richard Ellis on March 18th. Note that the situation we have here is quite fluid and can and will change, often hourly. For GDP growth, they're anticipating a drop of 1.5% in the first quarter and then 6% in the second quarter, which 2 consecutive drops technically put you into a recession. Then the economy will flatten out in quarter 3 and rebound and have a 2% growth in quarter 4. They're anticipating about a 3.5% growth for 2021. Their rationale behind this is they think the economic fundamentals were very strong before the virus, and they're anticipating that the virus will be relatively short-lived in terms of its impact. The unemployment rate they expect to rise from 3.5% to over 5% and then gradually come down. Now, the St. Louis Federal Reserve Bank came out and gave an estimate about a week ago that the unemployment rate could go as high as 30%. Fox Business estimates that 80 million jobs could be at risk. Moody's Analytics is close to that when they're saying half of the 153 million jobs in our country could be impacted by COVID-19. On March 26, we saw the largest jump in new unemployment claims that we ever have in our history of our country, at 3.28 million. The previous high that we had was 695,000 in 1982. And we saw from that one jump the unemployment rate rise from 3.5% to 5.5%. Now, the Credit Union National Association, their economic view was from a podcast on March the 26th. And again, they say, remember, the economic fundamentals that we have going on now were stronger prior to this as compared to the 2008 crash. For GDP growth, they think we're already in a recession now. 70% of the U.S. economy is based with the consumer. They're expecting that drop will worsen and will have its worst in quarter 2, assuming that the virus will subside, but it will get worse from that if it comes back. If it stays away, we'll have a good rebound, and we'll see economic activity return sometime in May through June. For unemployment, they're anticipating it to rise to over 6.5% and then settle at 6% at the end of the year. In terms of inflation, we're actually going to experience what's called deflation. They're expecting prices to drop. The possibility of this is a spiraling down of prices when people sit on the sidelines waiting for a better deal, such as they may put off buying a car today because they think it's going to be cheaper tomorrow. Deflation is a real challenge to any economy. For credit union growth, they're anticipating loan growth to be 3.5% compared to 6.5% of last year. I believe our loan growth is going to be surprisingly strong based upon the support of the federal government and some of the programs that we're seeing that have just come out. Deposit growth will end up being 12% compared to 8.1% of last year. The first question I think that many of us have is really, how long is this thing going to last? This is data from the American Council of Science and Health. Now, the y-axis over here on this side is basically, this here represents the number of people that are infected per 100,000 people that have to go to a critical care bed facility. And at the peak of this is only 0.3%. The x-axis that we have down here represents time, and time goes forward from here. Now, if you note here, in either of these cases, their best scenario is that this peaks sometime from mid-May to early June in every one of these scenarios, and then drops off. The negative of this is the time that it takes to drop off and get down to where we were before. If this continues to go, you could be looking at not reaching a position where you're into more of a normal state until, say, August, maybe September. If you're in that position, this is going to have a tail impact negatively on summer travel. And some of you are in areas where hospitality and tourism is a huge part of your industry. So anyway, be aware of that, and be aware also of a potential strong rebound in quarter 3 or 4. What is the impact? A good resource that I like to look at is from Johns Hopkins University of Medicine. And they have their own website for the coronavirus. Basically, it gives you pretty much real-time data as they have it. As of 12:54 p.m. Eastern Time yesterday on 3/27, worldwide we had 585,000 confirmed cases and 97,000 in the U.S., 26,819 total deaths with 1,475 in the U.S. But one thing that you don't hear about are those that have recovered. We have almost 130,000 people worldwide that have gotten the disease and recovered, and 816 in the U.S. I realize by the time you see this, these numbers are going to be quite different, but it's important that you have good, solid data that you can look at that's a little less biased than what you see in the media. The Federal Reserve has 3 different policy tools for monetary policy that they use. The first is they control overnight lending rates from one bank to the other. The second is monetary policy of the money supply. And the third is dealing with the reserve requirements of financial institutions. Those are the 3 main ones. They have made a huge drop in overnight lending rates. We started the year at about 1.75%. They are down close to 0.25% and close to effectively 0. Question is, will this be something that goes negative like they have in other countries around the world? This gives you a picture of the yield curve with the drop in rates. The current yield curve is a nice upwardly sloping curve that we would expect to see. If you note here, this also is the rate in March of 2019, which is the little dots here, which is kind of a bowl shape, and then a year earlier from that in March of 2018. On the other side here that we have is the spread between the 10-year Treasury and the 1-year Treasury. And note that in the past 7 recessions that we've had in the United States, they have been precipitated, or one of the factors has been tightening monetary policy, where the Fed has increased rates to where the short-term rate is higher than the longer term. We had a slight inversion in the curve last year. I think part of it is that we have a situation where there is a lot of other sovereign debt in the world that is at negative rates. Ours are still positive. I think there's a lot of money that was flowing in to the United States, which helped push those rates down. Other Fed actions. Again, the second thing the Fed does is they control the money supply a bit. The Fed announced a $700 billion program on the 15th to inject cash into the economy. $500 billion of this was with Treasury securities. $200 billion is mortgage-backed securities. This is an extremely huge stimulus package, and the stock market, the Dow Jones Industrial Average, proceeded to fall 3,000 points the next trading day. On February 23rd, or March 23rd, the Fed announced that they were going to purchase an unlimited amount of treasuries and mortgage-backed securities in whatever amount is needed to support a smooth market. For those of you that were in the industry in 2008, you remember quantitative easing, QE1 and QE2 and whatever QEs they had to kind of get the economy going. This is kind of open-ended quantitative easing, which basically the Fed's committed to do. This is a chart of the Dow Jones Industrial Average. I want you to welcome to basically the bear market. We were coming into the year with the Dow close to 30,000. We've seen well over a third of the value that's evaporated off of the Dow down to around the 21st or so, and then it's bounced up from then. Friday, we had a close of 21,636 after a couple record days earlier in the week. Basically, we've seen the Dow pull back quite a bit, and it appears that it's stabilizing. Remember, the stock market typically is going to be based upon investors' future expectations of what they anticipate is going to happen with the economy and with their stocks. We've seen other countries in the world, Germany and Italy, which Italy has really been ravaged by this virus. Both of them have had their stock markets bottom and are seeming to increase from here. Key manufacturing stocks like Caterpillar and Freeport-McMoRan, which they're a large copper producer, they're stabilizing as well. So we do see some potential with the markets looking forward that things are going to be better. There's really a triple whammy of problems here. There is the COVID-19 virus, but there's also two other factors that are negatively impacting the economy quite a bit. One of them is oil prices. We have seen crude prices drop. This is an older chart. On Friday, it was around 21.67 for West Texas Intermediate. Russia and Saudi Arabia are having an oil war right now, where they're pumping as much oil out there as they can to gain market share. This is going to hurt the U.S. quite a bit. We are the largest oil producer in the world. And fracking companies, with the technology to be able to frack and pull oil out, they need prices to be around in the $50 range in order to be profitable. We could see a lot of bankruptcies in the oil patch in this sector without a price recovery or some bailout. If you're in a position in the country where you're in western North Dakota, maybe West Texas, or eastern Colorado, or in Pennsylvania, even if you're not lending directly to oil company or a fracker or a driller or anything, your economy is going to be negatively impacted quite a bit from that. The third part of the triple whammy is agricultural prices. We have seen these things just really dive. This goes back, each of these charts, from October of 2019 with corn and soybeans, and then also with feeder cattle and lean hogs. So whether you have a farmer or a rancher, you're probably in a situation where the prices of the products have been dropped quite a bit. A lot of this is due to the fact that there's just too much supply of product in the world. We're dealing with situations in Brazil where they're trying to figure out how they can get a third corn crop to grow every year, when we just have one. They are just continually, all around the world, is putting more product that's out there. That depresses prices that we see. Now, this crisis is severe, but I'm not saying anything that it is not severe, or not trying to minimize this in any way, but I want you to think a little bit in the past 20 years of the other crises that we've had and how it's impacted us. The first one is Y2K. Those of you in the financial industry remember all the months and months of preparation that you had to do for Y2K, and it ended up being pretty much a non-event. Then we had 9/11 with the Twin Towers falling. We had anthrax. We had the West Nile virus. We had SARS, E. coli. In 2008, we had the financial crisis. I remember being in banking then when the financial markets completely locked up, and the fear and panic that created when you had investment banks that were failing. We had swine flu in 2009 to 2010. This is what amazes me about this current crisis. At the peak of the swine flu, we had 60.8 million Americans that were impacted, that were sick from the swine flu. 273,304 hospitalizations, and 12,469 deaths. Now, I do not know, and none of us know exactly what is going to happen with our current COVID-19 crisis. But to think that this is an isolated event and has never happened before, it is something that we have had other crises before in the past. Consider the 1918 Spanish flu. At the peak of the flu, between 25 to 33% of the world's population had the flu, and there were over 1 million people a week that were killed by the virus. The total deaths were around 50 million people worldwide and 675,000 people in the United States. So we have seen pandemics and we have seen great tragedies like this before, and this is something that we don't know where it's going to take us, but we have learned before and we can get through it. Meanwhile, I had a picture inside of a fridge somewhere of the various condiments and other food items that are quarantining themselves from the deadly corona. Let's talk about commercial real estate. What sectors of commercial real estate are strong today? Well, the first one I would say is multifamily, with the exception of student-dominated housing. And I think we have a little bit of a possible slippage that we're going to see in areas where there's a high amount of unemployment. Multifamily is very strong because we have not built up the housing stock that we've needed since the crash and of 2008. So we're still behind on that. And I think that is still going to be a main driver and a very attractive, real estate type we would see going forward. Logistics, anything that's dealing with, transportation, warehousing. Amazon has announced huge increases that they want in staff, and they're looking at more warehousing, as are other distribution centers that you see from other retailers. Industrial. U.S. factories, we see more of them going back to work, and more of them are also switching their industrial capacity in order to make things to fight the coronavirus. Grocery and pharmacy anchored retail. Anything that sells items that are necessities have seen their businesses soar. C-stores have been strong as well. Think of pizza delivery. Domino's has announced they want to hire 10,000 more drivers all around the country to take care of the delivery. A restaurant that's delivering, those are also have been relatively strong areas. Some medical has been strong as well. Some of the risk you have here are loan defaults and potentially large corporate failures among some of these. What are some areas that are questionable? Well, the first is office. We have a short-term slowdown in office, and it may be impacted in other areas than others, in some areas than others, but the long-term impact here is unknown. What's going to happen once companies figure out, we were able to work fairly well remotely and not have this office expense? Maybe we should look at doing that and scale down stuff. Will more people work from home in the future? Will there be less of a need for offices? Real estate development is something also that's unknown. A lot of this is based upon what was the development going on beforehand, what sector of real estate was it in? Will they have the ability to complete the development? If they were building, for instance, a retail center beforehand and you have tenants lined up, are those leases going to have to be renegotiated to a lower rate to keep the tenants? So there's possibly some negative long-term impact as businesses try to figure out what's exactly going on and how it's going to impact the developers as well. Some real negatives on commercial real estate. The first one I would say is student housing. I think one thing the coronavirus is going to do is have a real negative drag on student housing, because a lot of students are going to realize hey, I can save the room and board expense at the university, stay at home, and get my degree remotely. Um, Universities, many of them almost all around the country, were closing campuses that they had, in the past month or two, and just sending students home, and they still have to get their education. Senior housing. We were seeing softness already in the senior housing market before this started. There is a tendency for seniors to want to age at home as opposed to going to a nursing home or a facility. Also, there is a smaller population in the generation after the greatest generation that's there and with the population and demographic shift, there's less demand that we're seeing. And the other thing is, and we saw this with unfortunately with the senior housing complex in the state of Washington, where we saw a lot of deaths that were all tied to the coronavirus. We're in a situation that anytime you have one of these, it's like a giant petri dish for whatever types of diseases that they have that are passing on from one to the other. Senior housing is going to be negative, I think, going forward, because there's also more opportunities to, with telemedicine, with some in-home cares that can come with people that can actually help and people to stay at home and age. Non-essential retail is definitely a negative that we see right now. There's going to be a lot of companies that are already announcing, and I think this coronavirus may be the final linchpin in some of them that just puts them out completely. Restaurants, in-dining restaurants, Open Table reported in San Francisco that on March 19th, in-dining restaurants in that area saw a drop of 98% of patrons. We were in a community that last night, Rapid City in the western part of South Dakota, the council voted to close down all in-dining restaurants and only allow drive-through and pickup. Hotels. Now, this data, these statistics are from CB Richard Ellis from the early part of March. They were seeing year over year RevPAR drop of 32.5%, in some areas over 60%, and they expected RevPAR to drop 37% for the year. This is a lot worse than these numbers. We have seen some hotels in our portfolio that we manage that are completely closed. We have seen others. Some of them have closed because there just wasn't business. There's others that have closed because they've shut down other facilities that they had, which drove business to the hotel. The governmental entities did. We've seen others that have occupancy rates that are in the low single digits and the low teens. And this is just horrible where we are with hospitality right now. I will note that there are some special provisions in the CARES Act that we'll talk about a little later that's going to have some positive impact on hospitality. Any business that's shut down by state or local governments that are deemed as non-essential, the real estate underneath them is at risk and has issues. We have 70% of our economy as consumer spending. And as you have either voluntary or involuntary shutdowns and shelter at home, and people that have changed their attitudes and their actions with how they're actually, working and traveling and everything else, it has an impact here. Some questions, one question I had is movie theaters. Will we see movie theaters survive this? I think some will, but I don't know if they'll survive at the same level that we've experienced in the past. There's going to be more streaming services. And I know more of a desire for, instead of going for the movie experience, to stay at home where you're safe. Let's talk about challenges for financial institutions, and I first want to start with your people. I know you all have probably had discussions on this, but what do you do if a team member thinks that they have the virus or they're confirmed to be infected, or somebody in their family. What do you do then? What if you have confirmed cases in your building and you're in a multi-tenant office building with other tenants? What if you have cases among your membership? What if schools or daycares close? I mean, this is something that's probably happened that you're experiencing. You have parents of young kids, and what do you do now that those kids are basically homeschooled? How's that going to work with balancing work and school? What happens if mass transit ceases for those who use it? And the question you're probably all asking is, who really just has to work at the office? Who can work from home? Some other challenges financial institutions are going to see, and I assume you're already experiencing them. We will have a higher volume for refinance requests. Both people that have great credit and people that have horrible credit. Everybody's seeing rates are low and they want to take advantage of it. The near zero interest rates will have a distinct net margin impact pressure. So your net interest margin is going to be going down. Faster savings and potentially faster asset growth. On the saving side, more people want to save money and they're not wanting to spend it. On the asset side, we will see strong asset growth from some of the backings of these government programs that we have that are coming out. And also we'll see some stronger asset growth because projected runoffs that we had on loans due to even amortizations in some cases are going to be pushed back because people aren't able to make their payments. There will be a significant increase in loan delinquencies, losses, and challenged credits. There's going to be an overall downward pressure on net income, and we'll also see lower net worth ratios industry-wide, but also those net worth ratios, I would note, are stronger today than they were before the last financial crisis. Let's look at other commercial real estate lending sources that are out there outside of financial institutions. There is still strong activity, with most of this being refinancing from short-term or higher price loans to go to cheaper rates. The agencies are still providing loans for a majority of large multifamily projects. They're also responding very quickly and more flexibly to requests, and we should continue to see that as well. Life companies have remained in a rate range between about 3.25 to 3.75. There have been times where there's been some disruptions in the corporate bond market, and they've tended to put some of these on the sidelines. I'll mention that the CMBS market for the collateralized mortgage-backed securities have gotten quite a bit more conservative. We have seen debt yields in that market on deals that have been somewhere between the 15% range or higher on good deals. This is something that's unheard of that we've had for years, for years. And bridge lenders are also back with wider spreads and lower floors. The COVID-19 crisis is going to present challenges to your borrowers, as will the other parts of the triple whammy of low oil prices and the poor ag economy. Everybody's going to feel it. Many of your troubled borrowers you have are going to be governed by fear and anger. You may be the only one, as a lender, that has some of the essential keys to protect their business, help preserve some of their equity, while keeping your institution sound. It's important to keep your head, to stay healthy, make sure that you eat right, get rest, exercise, work to manage your stress and the stress that you have for your team. I want to take a minute on this slide, or a few minutes, to talk about some actions for leaders from John Maxwell. John Maxwell is one of my favorite leadership authors, and I would encourage you that if you have not read him or picked up his stuff, to find it and to read it and make it part of your regular arsenal. The first strategy here is to put people first. You need to begin each day when you come into your office or you're sitting in your chair at home to ask, how can I help How can I serve? How can I lead? How can I love people? And have actions that support that. Now, this doesn't mean giving away the store, and if somebody comes in and wants a 1% 30-year loan, you're going to do that because you got to be profitable. And if you're not profitable, you're not putting the others in your membership first. But you need to start with that. Start putting people first, and the other stuff is going to work out. The second strategy is to educate yourself and your team. Know what the issues really are. When it comes to the virus, when we had AIDS, it took 2 years for us just to figure out what the virus was. With COVID-19, we had that figured out in 2 weeks. We have seen a remarkable acceleration of knowledge on all fronts that we've seen. We've seen government action that's been faster than anything we've seen before in the past. We've seen scientific advancement that's been faster than anything else. So even though this is a daunting task and we don't know what's going to happen here, there's still a lot of positives that we've seen. Be smart with personal hygiene and so keep your social distancing as well. I'd consider limiting some of the news you watch. You know, there's no news station that starts its day by saying, I wonder what I can do to add value to Phil Love. No, what they're doing is they only want ratings. Also at this time, find ways to build up your skills in your career and personally in leadership. The next step is to be flexible. Lots of change is needed. I'm thinking about some studies that came out of the Korean War, and the question was asked was, why did American pilots have a kill ratio of 10 to 1 compared to the enemy when it was widely acknowledged that the MiG planes supplied by the Russians were much superior to our fighters? And it was studied after the war, and it came down to 2 things. The first was the canopy of the aircraft that we had a greater view distance than what they had with the MiG fighters. So we could see stuff sooner. The pilots could. The second was that it was an easier process for a pilot to get his guns in place on an American plane and shoot than it was for the MiGs. And with that, there was a leadership strategy that was called the OODA loop. OODA stands for 4 steps: observe, orient, decide, and act. And that is the loop. The quicker that you can do these steps, and then once you get through the act step, you go back to the observe. Once I've implemented this strategy, what has impacted in the market from the strategy, what's changed in the market, and you make decisions from that. And you continue to make changes like that way. The faster you can go through the OODA loop, a lot of times the more successful you can be. So be flexible. Leverage your team, number 4. Some of us that are have a little gray hair and have a little experience under our belt, whenever there is a crisis mode, we may have a tendency to go out as a lone ranger and just get stuff done the best we can. And that's not necessarily the best way to do it. You need to have other people around you. You need to be training them and supporting them, because this is a great learning opportunity for them as well. Communicate judiciously. Less talking, more thinking. Make your words count. Be authentic. Leaders touch a heart when they're authentic. And as a leader, you're not going to get somebody to follow you until you've touched their heart. Admit when you do not know the answers. There's nothing wrong with that. But you can say, hey, we're going to get through this together. I know we will. And finally, the most important person that you have to lead is yourself. You need to make a choice every day to feed your faith, to starve your fears, and to move forward. Now, let's talk about some actions now for credit administration. You should all have the ability with your core processing systems and other computer programs you have to identify your borrowers and your guarantors by industry, by geography or location, maybe by your revenue sources, main revenue sources or such. And you should use that data to be able to split up and divide up your portfolio. Consider who are tier 1 entities. These are going to be businesses that are directly hurt by the COVID crisis. There are going to be hotels, restaurants, non-essential walk-in retails, oil production, if you have that, fitness clubs, agriculture. A lot of agriculture is going to fall into this. We have things here in my town that are water parks, hookah lounges, and stuff like that. Those are all directly impacted by this because of shutdowns, whether there's no business or whether it's been because of a government entity. Also on this, consider entities that are benefiting, such as pharmacies, grocery stores, items like that. I also want you to consider tier 2 entities, and I would consider these to be entities that are not directly involved in the business like tier 1, but are impacted by tier 1 challenges. An example I have here is I have a strip center in the Kansas City area in our portfolio that is, majority of the tenants there are a mixture of restaurants and non-essential retail. And they're basically under a 30-day quarantine. I think this is day 3 of a 30-day quarantine, and all those businesses are shut down. So there are tenants that are coming in asking for rent concessions because they can't operate. Consider those as well. Once you have that list, you should be able to identify, maybe break up the list into quartiles as to what is the top 25% of my borrowers that are impacted by this, all the way down to ones that have not been impacted. Now, you should already probably have heard from all of your top 25% of your customers, if not more. And if you haven't, you need to reach out and contact them. By contacting them is not to offer off the bat just any sort of deferment they need, but first find out, how are you doing? What's going on? What things are you doing to survive this? And then what do you need? And then how can I help you? I would consider also the impact of leverage. If you have a business that's highly leveraged, they're probably going to be impacted more, especially if they're in your tier 1 negatives. A low leverage borrower that has collateral that might not be as desirable could also face greater impact. Realize that things change. What you think is not impacted today can change tomorrow. What happens if you have a government shutdown in a community and impacts some of your businesses? What if you have communities that were not impacted before that get hit? What if you have businesses that weren't impacted before that got hit? What do you do if you have let's say you have a loan for a plumbing company that has 10 employees and they get hit with a coronavirus, and all of a sudden, instead of 10 plumbers out there working, maybe they're down to 2. What impact are you going to have there? You need to watch events carefully, learn to think critically, and then expect the impact that you're going to have on an economic downturn. This all goes under the point of being flexible. Let's talk about some business credit options in these challenging times. If you have an operating line that's coming due, maybe you could extend the maturity longer than what you normally would because of the circumstances, or approve some reduced interim financing. Maybe there's a forbearance of principal and interest payments over 3 to 6 months for those that are impacted. There are a lot of different ways that this could be structured. We'll talk about some others as we go through here. I would want to require monthly financial updates. The borrower, you'd want to have them actively seek any state and federal disaster assistance that's available to them. The lender can assist within reason, and in some cases with the new programs that are out there, you will be doing the lending for them. At the end of the deferment period, you're going to need to review the need to extend the payment deferment. Or you may want to modify the loan to address the deferred P&I in a manner that best meets the needs of the borrower and the lender. Some other things you might do, and these are conventional items that are outside of government guaranteed programs. Maybe you offer a special line of credit that doesn't have payments for a few months. Maybe you offer lines of credit to strong borrowers with good equity position. Maybe you refinance. Look at refinancing some loans where they have good equity position and get them to a lower rate to improve their cash flow. Or maybe you look at an SBA Express line of credit, and we'll talk some more about that. It's important at this time to monitor your borrowers closely. When I was in banking at the time of the crash, I estimate I probably spent 70% of my time looking for new deals and 30% on the existing ones. When the crash hit, basically 100% of my time was spent on existing deals or borrowing that was inside that existing portfolio. And that is something that's going to happen with your credit management team. Is your team it's going to be a very busy time, but there's going to be a lot of more insight that you have on your existing borrowers. Watch for regulatory changes. A big regulatory change we've had is how TDRs are handled. A couple Sundays ago, the NCUA came up with their letter 20.fcu.02, basically stating the agencies have confirmed with FOSB that short-term modifications made in good faith in response to the COVID-19 crisis to borrowers who were current prior to any relief are not to be considered TDRs. It includes a short-term. Their example is a 6-month modification, such as payment deferrals, fee waivers, extensions of payment terms, or any other delays in payments that are insignificant. This has been a uniform response from all lending regulators. Let's talk a little about how do we risk grade this stuff now that we've actually made these changes. And I'm going to give you some thoughts or options here. There is no right or wrong answer. This is really something that you have to decide for your institution how you're going to handle stuff, and then and handle it that way, and then justify it if you are called on. Most of your modified loans right now are going to fit your definition of a watch, or more likely a special mention or worse rating that you have in your current risk rating. So a question is it right to drop all those temporarily impacted to a classified category? One thing you may consider doing is you need to do a qualitative adjustment, because you probably all have a factor in there for the economy. Well, in most cases right now, there is a negative impact in the economy to most of your borrowers, or many of them, and that would be a thing that you'd want to look at. One option is to drop to the lowest pass rating and create a category specifically in your risk rating for COVID-19. And then borrowers that are in that category need to be reviewed within a year and then moved to an appropriate category. You could also drop to a classified rating, but mark on your tickler different actions that you need to do, and you know your actions are going to be increasing with this. You need to also watch for future guidance from the regulators and track any of impaired customers that you have on your system. This is very important that you do, so you can track the actions that you've been doing. Let's talk about the SBA's Emergency Industry Disaster Loan Program. These are available for small businesses, most private nonprofits that are not tied to religion, agricultural cooperatives. In some cases, these economic injury disaster loans are also available for individuals. If you had like a tornado or a big hurricane, like we saw the tornado recently in Nashville, Tennessee, in that area, it's possible if it is declared a disaster area that you could have homeowners that could use the EIDL program. This is going to primarily impact businesses directly involved in the disaster, and businesses offering services to those businesses in the declaration, and other businesses indirectly related to the industry that are likely harmed. By now, probably almost every county around the country has been declared a disaster because of the virus. The loans are up to $2 million at a fixed rate, starting at $375 for a small business and $275 for a nonprofit. Has a term of up to 30 years. The eligibility for these is based upon the size and type of business and the business financial resources, and they can be used for working capital to pay debt, payables, other bills. It's not intended to replace lost sales or profits or for expansion. And these loans are done directly from the SBA. So your borrowers would apply online to disasterloan.sba.gov. Now, I've heard that the Chrome browser does not work very well with this for some reason, so they may want to use a different browser. They also need to expect that there's going to be some delays and lags because there's a tremendous amount of traffic for people that need these type of loans. If the loan's over $25,000, they will require collateral, and SBA will want real estate collateral if it's available, but they will not turn down a loan for lack of collateral. Now, with the CARE Act that was just passed last night when President Trump signed it, there's no personal guarantees for these EIDL loans below $200,000. This gives you a list of some ineligible entities that you have. If any of these are there, they are not going to qualify for the loan. And again, you'd apply online, they have to, and the loan's directly from the SBA. And any existing disaster loan that a borrower may have with the SBA will have their payments deferred until 2021. Let's talk about SBA 7A loans, and if you're asked to do a deferment on that. If the loan's not sold in the secondary market, you can do a 6-month deferment unilaterally without the approval of the SBA. Now, that's being changed with the CARE Act of up to 12 months. If the loan's sold, you have a 3-month deferment that you can do unilaterally on your end, or you have to get the concurrence of the note holder. On your Colson report, your 1502 lender reporting, your status on these, go to a status 4. You need to carefully document the file according to the SOP 5057-2. Borrower's financials should be reviewed and analyzed prior to granting the deferment. Now, there will be some cases that you will be doing this without getting that information beforehand. And if so, you still need to be judicious in getting the information and documenting the file. Make sure that you're documenting the deferment reason as due to the COVID-19 economic disruption. Do not use this as a time that, hey, if I got a borrower that's weak, that I'm going to go ahead and do, or that's been weak for a while, that I'm going to go ahead and do the deferment. If the loan's already over 60 days late and the problems appear to be long-term, you need to classify the loan in liquidation and select a more appropriate action. If you have a borrower that has a 504 loan, they could defer up to 6 months of payments or 20% of the original amount, whichever is less. In many cases, they will come to you to defer the first mortgage payment. You need to tell them about the option of going to the CDC that is servicing and taking the payments on their second loan, so they could ask for that one to be deferred as well. Let's talk about some payment options during deferment, and this is from the SBA. They recommend that if there's a way to keep a payment going, even if it is a small payment, that will not cover all of the amount of interest that's due, to continue to do it. It keeps the borrower in the habit of making a payment, and if you have a pre-authorized debit, it's going to keep that method active. Interest should continue to accrue during the deferment payment, and that interest accrual can be handled by one of a few ways. First, the borrower could elect to just pay the interest as it goes. Second, the deferred interest could be paid in one lump sum during the deferred payment or at the end of it. The third option is after the deferment, the loan payment can be increased for a period of time necessary for the borrower to catch up to the original amortization schedule. So maybe you take that additional amount and you spread it over 24 months and they make that additional payment until they are caught up. Also, when payments resume, you could just leave the payment as it is, and it's going to be applied first to accrued interest to catch that up and get that, and then to principal. These are all some options on that you would have available to you. And a thing that we talked about in our shop is, what do we do if a borrower actually has a turnaround in this time prior to the end of the deferred period, prior to the end of, say if we defer a loan of 6 months and after month 2 their revenue is at the same level of what they were last year or even higher, and they're continuing to go higher, maybe we have some contingencies in there to bring it into an interest payment. Let's talk about the USDA Business and Industry Loan Program on some options there. I'm first going to go over what are standard items that USDA wants for their renewal, for their deferments, which is a written request on your letterhead that addresses the situation, your action, and your recommendation, their current financial condition, less than 90 days. Number 3, borrower's most recent fiscal year-end financials. Number 4, guarantor's current financials. And number 5, a draft copy of the debt modification agreement. It's standard operating procedure with the B&I to have all of these items. However, they have a thing that came out that through July 31st, if you have a B&I or a Rural Energy for America loan that is $10 million or less, you can unilaterally make the decision on your own and notify the agency that it occurred. The payments can be deferred no longer than 4 months or 120 days. You have to notify the agency in writing, and most importantly, of anything that we have here, you need to make sure that you document the file. If the loan is sold secondary market, or you have a portion of it, the guaranteed portion has been sold, the note holder and the lender have to agree to those terms. Let's talk about the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act. This was signed by President Trump last night. It is a over $2 trillion economic boost. This $2 trillion is about a tenth of our entire federal debt. This is the largest program by far that we've seen economically, larger than the New Deal of Franklin Roosevelt. I'm going to go through a few sections in this This is about a 900-page document, and we've got a summary of some items here, but it is going to be very good for you to get used to this really quick. With the signing of this last night, I began to get some contact from some of the borrowers that are in our portfolio within the matter of about 2 or 3 hours. The first one is the Paycheck Protection Program. Any small business defined as with 500 employees or less, and even independent contractors and self-employed individuals could qualify for this. The first thing it does is it waives the affiliation rules for businesses in hospitalities, restaurants, and franchises. Now, SBA, for those of you who might not know, have size limitation standards. And one of these is if you are of a certain size and you have other businesses that you have partial ownership on that you're considering their size as well, then you're deemed to be too large for the SBA to do a loan. This is a situation that rule is gone out the window. The business had to be operational on February 15th, 2020, had to have employees that it paid salaries and taxes to, and had to have been impacted by the COVID-19 virus. There's no borrower or lender fees paid to the SBA. There's no credit elsewhere test. In other words, a lot of SBA loans, there's somewhere in your underwriting that you need to state this has to be done by the SBA because they are not able to obtain financing at these terms anywhere else. There is also no collateral needed. There's no personal guarantees. If any part of the loan is not forgiven, the balance is paid in up to 10 years. Now, put a pin in that in terms of the thing on the not forgiven part. We will get to that in a minute. 7A loans on the SBA are guaranteed to 100% through December 31st, and 75% for loans over 150 and 85% for smaller loans. Now, one thing you should be aware of is they are opening up the floodgates that even if your institution has not signed up to do SBA loans before, you have the opportunity to serve your membership by doing these. Okay, the part about loan forgiveness. Let's talk about that. A borrower can have a portion of their loan forgiven equal to the amount spent by the borrower during the 8-week period after the origination date. That can cover payroll cost, can cover interest payments on any mortgage incurred prior to February 15th of 2020. So the mortgage had to have been in place prior to that, or rent or lease that was in force prior to that, and also payment of any utility service that began before February 15th of 2020. The amount forgiven will be reduced if employees are laid off, or if you have employees who have had their pay reduced by 25% or more from a prior year's compensation. The borrowers verify costs by documentation to the lenders. The SBA will purchase the loan from the lender for the expected amount of the loan forgiveness. The canceled debt will not become part of the borrower's taxable income. So what we in essence have here is a grant for 8 weeks of the business's salary expense, and that's anything that's dealing with payroll, interest expense on any mortgage that they have, payment of rent, and all utility costs, that they will be able to get a loan from the institution, credit union or bank, and not have to pay back. Let's talk about other portions in the Act. There's expanded unemployment benefits in sections 2101 to 2114. In 2201, there are also going to be checks going out from the government, $1,200 for a single person with income up to $75,000 and $2,400 for couples with AGI of $150. This is based upon your 2019 tax return, if filed, or your 2018 return if you have not filed it. This amount is reduced and phased out as the incomes get higher. Section 2202 gives you the special use of retirement funds. You're going to be able to draw money out up to $100,000 of any qualified retirement plan. That would be an IRA, be a 401k, and this can be done without the 10% withdrawal penalty for coronavirus-related purposes. The income tax on this is spread out over a 3-year period. Section 2204, charitable deductions. One of the groups that is going to be hurt the hardest here are charities. You know, you think about churches that get most of their donations on Sunday when they're taking offerings, and now they're not meeting. So, you know, there's definitely a mind shift that needs to be done there. But one positive here is even a person who does not itemize, they can deduct up to $300 of cash contributions in 2020 from their income for tax purposes. Section 2301, delay in employer payroll taxes. The employer can delay paying the employer's portion of the Social Security tax in 2020, which is 6.2%. And pay half of that at the end of 2021 and the other half at the end of 2022. Section 2305, raise the limitation on the business interest expense. In some cases, if there's not enough profit in a business, their interest expense is reduced to 30%. That is able to be taken off for tax purposes. Now that's increased to 50% of taxable income. Section 2306, qualified improvement property. For tax purposes, the businesses can write off immediately any cost associated with improving facilities instead of depreciating these over a 39-year life of the building. This is a huge impact on hospitality, on any sort of business new business that's being built now, you know, for real estate or anything like that, or equipment. Is a huge impact tax-wise that we have here. Section 4004, limitations on employee compensation. If a company that receives benefits from here, you know, from the Act, they cannot increase the compensation of any employee who has total compensation over $425,000 annually. Here we go to the TDRs again. There's a temporary relief from these. What they're doing here is saying that loan modifications related to the pandemic are not to be reported as a TDR from now basically until 60 days after the lifting of the health emergency. SBA Express loans, which these are wonderful loans to get into. They provide you a 50% guarantee from the federal government. Their maximum amount of the Express loan is being raised from $350,000 to $1 million through the end of this year, and then $500,000 after that. 7A loans. The loan limit on a 7A loan is going from $5 million to $10 million. Now remember, the 7A loans have a 100% guarantee from the federal government through the end of this year, and then it drops down to 75 or 85 depending upon the size. After the end of this year, 7A loans will have limits that are set on the program tied to the payroll cost that's incurred for that business. So there is a lot of good stuff that's going on in this Act. Now note, the Act gives the SBA 15 days to get all these regulations worked out on how this is all going to be implemented. So I would expect, similar to other things that we've seen with this administration and this crisis time, that things are going to be moving at warp speed. This has a tremendous opportunity for you to help your membership. Another thing on us that I didn't put in here, but I read as part of the Act and I haven't gotten into it, is a business is able to pay up to, I think, $5,250 of student loan payments of one of their employees, and it not be considered as taxable income for that employee, and it is considered a business expense on the business. So a nice little feature there. This gives you a couple different website URLs for SBA and the CDC and stuff that you could be using if you want to get more information. I want to move to talk about personal credit. Some of you that are going to be listening to this deal with individual borrowers, or maybe you have leadership responsibilities or management responsibilities that oversee not only the commercial side or the agricultural loans in your institution, but also the personal side. What do we do now with our individuals? Well, one option might be to provide a member with a loan equal to the amount of the federal assistance and giving them 90 days of no accrual of interest or no payments due. If the loan's not paid in 90 days, you can set up an amortized loan payment. Another option is to advise members that their loan payments will be deferred during the national emergency period if their income has dropped 50% or more because of the COVID-19 virus impact, but continue to accrue interest during that time. If you have people that qualify for a home equity line of credit, or maybe they qualify to refinance their house and reduce their payments, reach out and market those. Those are huge importance. Have open communication channels with your members. I think this is something that we do pretty well as an industry, but this is an important time that people need to hear from you. Try to encourage them to communicate with you and see if there's ways that there's other things they need help with. We have seen credit unions that have reached out to buy meals or errands and drop them off on the doorsteps of elderly people that need help. We've seen others that have gone to food banks and have helped pack food that then has been, prepackaged and delivered as well. There's just a lot of things here today that we can do to love our neighbor and to make a difference. Let your members know that your credit union is open and available to help during this time of crisis. Some of them, because your lobby is shut off, or maybe you have a branch that's shut down for one reason or another, they may not think you're there to help, but this is a time that you need to reach out. Assure them that you will. Maybe what you want to do is to set aside some money for emergency loans. Assure folks you're going to keep your ATMs functioning during the time of crisis so that people can obtain the cash that they need. All right, I want to take a little bit of time and let's move on from where we are today. We spent a lot of time already where we have talked about the crisis itself, how this has impacted our economy. We talked some about our health. We've talked a lot about how this has impacted your borrowers and different programs that the government is coming up with, from the SBA, through the CARES Act, through USDA BNI, other sources there that are available to help you, to help your members. Let's talk about what are we going to do now to move forward. There's going to come time that we're going to be out of this. There's going to come a day sometime in the not too distant future that you're going to begin turning the corner from people that need relief and need payment deferments and need loans just to help them make their payroll and stuff like that, to actually a time where they're ready to grow again. So you need to plan for a higher volume of new loan requests now. And that is going to accelerate more once the economy is stable. Make plans on how you're going to price your loans and how you want to do strategic loan acquisition now. Now on the commercial side, you should be able to identify desired customers. Maybe even on the ag side, there's a desired producer who's always hitting home runs, has very low, very low leverage. These are ones you want relationships with your institution and in your portfolio. You need to make plans on how do you acquire those now. This is a wonderful time to build relationships. Look to adjust your risk tolerances on various loan types. What I would say here is there's some of you that are real conservative, and maybe you're only doing 70% loans on multifamily. Maybe you need to consider 80% or maybe a little higher because of the strong fundamentals for deals that make sense. On the other side of the equation, there's some of you that are at 75% across the board, even if somebody brought you in a new hotel deal. Well, if you don't have a government guarantee on that deal, on a hotel, then you're in a situation that maybe you need to look at possibly dropping that down from the 75%. Maybe you need to be closer to 55% today. There needs to be some adjustments in how you're going to view your loan to values, your loan to cost, thresholds for debt service, and your debt yields as well as you're judging your credits that you have that are going forward. Help your clients build up more reserves. Clients, we do need the economy to expand. We need them to be successful. But one of the things for them to be successful is to deleverage and to find ways to have more cash reserves. Overall, there is a wonderful opportunity here for people that we have, and a wonderful opportunity we have to serve. I'm reminded of a story of a gentleman who was very wealthy, and he had two sons. And he thought he would do an experiment on the two sons. And one of the sons always had a sunny disposition, was always positive. And the other one was just negative as could be. There was just nothing that would please him. So what he ended up doing is he took the one son that was negative, and he went and bought every imaginable toy that any kid could ever want and filled it in this giant room that was his bedroom. And the other son, he took his bedroom and took and filled it with horse manure. So he brought the sons in to show what they had, left them be, and then he came back and first came back to the negative son and said, "Well, how are you doing?" He said, "Oh, I'm doing horrible. These toys, this one that you got me, this new drone needs batteries, and I just don't have the right battery. I can't get this put together. These things just don't work the way they need to. I wish this was a bigger one. You had this car. I wish I had, an ATV that was bigger than the one you got me," and just complained on and on and on. There's nothing that made him happy. He goes to the other son, and he finds the boy in the room with a shovel, shoveling as fast as he can, and he's singing, and he's joyful. And he asks, "Son, why are you this way?" "Because your room's filled with horse manure, and you're happy." And he said, "Because, Dad, I know that if I have this much horse manure someplace, there's got to be a pony in here somewhere." So that's what we're up against here. Folks, there's some really big horses and really opportunity here somewhere. We just got to stay positive to get to them. At Pactola, we're here to help. We're here to be your friends. We have seasoned commercial and agricultural loan experts that have a deep experience with credit analysis and underwriting, both in loans that have a government guarantee on them and also loans that do not have a government guarantee on them. We have a lot that we can provide for you. We also have a team of ex-examiners that are retired, lending managers that have been with institutions and have had big lending positions, and they can offer help with things like problem loan structure if you need help on that. Maybe you have a third-party loan review that you've had a relationship with for years, but you're just, maybe it's that thing that just gets thrown into the file cabinet until the examiners come out, and you're really spending a lot of money on something that's not giving you a good analysis of where you're at and giving you actionable intel for you to improve. Or maybe you need a third-party loan review done, or oversight of your current credit risk advisory services. We can help with that. What about lender education? We spoke earlier that this is a tremendous opportunity to strengthen the lending skills on your team. Watch us for remote learning opportunities that we're working on offering. And if you have a need for any particular topic, then reach out to us, because we can move that from the back burner up higher. Contact me. My name's Phil Love. My email is phil.love@pactola.com. My phone is 605-223-5154. We look forward to serving you. Thank you for taking time to listen to this, and I hope it is useful for you to get some perspective on what we have going on today. Thanks.